the minimum value of a call option, that's for any type of call option, meaning either European or American. Now remember, European options, you can only exercise them at expiration, on the expiration date, whereas American options, you can exercise them at any point up until the expiration date. We'll be using both, American and European. We'll be discussing both of those in this chapter. So let me give you the boundary conditions here for the minimum value of a call, and that looks like this. And so I'm going to apply this. See the CA? The A stands for American. And let me walk you through the notation. It's a good time to walk you through the notation, because if you look at the notes, page 1 of the notes shows a lot of notation. It's like overwhelming. It's a nice summary there, but I can unpack that notation nicely, and I'm going to do it right now. So let's, for the moment, look at a call, an American for the moment, option, and its valuation here. Its minimum value. And so we're looking at an American call. That's what that stands for. So we're looking at the price of this call, the value of this call for the stock at time 0. It has a certain expiration date, T, which is in fractions of years. And then X is the strike. And what we're going to say is the minimum value of this option is the maximum of 0 or S subscript 0X. Okay. Now, this term right here is this term is called the intrinsic value of the option. Okay, and so let's look at what this is saying. It's saying, look, the intrinsic value of the option, this option has to be worth at least this amount. Okay, and how do you interpret this? Well, if the option is out of the money or exactly at the money, then the option is not worth anything. Okay, that's 0. And then there's a comma here, and then it says S minus X. And that is, if the option is in the money, then the value of the option, the intrinsic value here, is going to be S minus X. Okay? So the minimum value of an option, of an American option, is it's either going to be 0 if it's at or in the money, or it's going to be worth the difference between the stock price and the strike. Okay, that is the lower bound on an American option. We'll discuss in a few minutes the lower bound on a European. Okay, so let's continue here. Let's do an example of how this works mathematically. And by the way, the notation here, it works very much like you would see in an Excel spreadsheet. If you wanted to find the maximum between two components, this component and this component, right, you would literally type in Excel at or an equal sign max, in the brackets here, and so that Excel will actually evaluate this function, because it is a function. So let's apply it with an example. Suppose ABC stock trades at $40 a share. Okay, so I like to write things down as I go through the problem. And you own a 3-month American option. Okay, so T is 3/12. It's a quarter of a year. The strike is 36. Okay, what is the call's intrinsic value? What is this component right here? Okay, so notice the problem is laying out the information you need to describe a call option. And so let's look at it here. We're going to call this IV the intrinsic value. So IV is the maximum in this example of 0, right, or 40 minus 36. And what's the greater? What's greater, 0 or 4? This is 4. So the intrinsic value is 4. This option is in the money by $4. And if you had it, and it's an American option, meaning you can exercise it right now, you can get your hands on this intrinsic value. Okay. Now, furthering with the example here, it says what happens if the stock price instead is not 40, but instead is 32? Then what's the intrinsic value of this option? Well, 32 minus 36. 0 is the intrinsic value. Why is that? Because this component here is negative 4. It's out of the money. And so 0 or 4, or negative 4, well, 0 is the maximum. So what it's telling you is that an option can never be negative. You can't have a negative value for an option. And right away, just to give you a really brief thought about this, because I'm calling them boundary conditions and I'm talking about graphing earlier, is that, look, you can think of this as here's the stock and here's the call value, right? And we want to graph the relationship between the call and the stock. It's one of the most important relationships here, because this is the call and then this is the underlying. So how does the underlying cause the change in the call price? Well, if you look at this carefully, you would know that, well, if this is the origin here and this is the 0 point, well, stock prices can't be negative, so you can't have anything on this side, right? So, okay, that makes sense. Now what I just told you is the minimum value of a call can't go below 0. So you can't go below this, line. So this is all excluded immediately. So pretty quickly, without even thinking about it, we can chop out this area. And now this boundary condition just chopped out this area. And now we're working on this area, and I'm going to confine that space even obviously to a smaller area. And that's what we're going to do as we build up these boundary conditions. Okay, so that's where we're going here. Now, let's look at the maximum value of a call option. Yeah, the maximum value of a call option. Well, if you think about it, all you can do with a call option is convert the option into the stock. You can exercise the option, convert it into the stock. So therefore, the value of a call option can't be worth anything more than the underlying stock price. So the way to write that is, and this applies to any option now, American or European. And so there's no symbol here. There's no A, there's no E. And we're going to look at a stock price at time 0, T, and X. And so that symbol represents the value of any call option for this stock at this time, expiration for the call, and then that strike. And what we're saying is it has to be less than or equal to the stock price at time 0. Okay? So this is the maximum upper bound. Another way to word it is the upper bound on the price. So the option price has to be less than the stock price or equal to it. In fact, the equal sign, it's rarely going to be equal, although I'll show you theoretically when to impose this little half an equal sign. When you look at these boundary conditions and you see less than or equal to, greater than or equal to, the half of an equal sign basically means you're on the boundary. Okay, just as a note. Okay. Now, as I say, I'll get into conceptually when we can actually get that to be on the boundary, and that happens just quickly, and I'll get into it further. When the strike is equal to 0, or the expiration of the option is unlimited. There's no time limit on the option, so it expires infinitely out into the future. Okay, so that's the second boundary condition. Let's look at another effect, another relationship that we should know here now, is that the longer the expiration on an option, the more valuable it is. And so it doesn't matter if it's American or European in this context. So we're going to say the value of a call on a certain underlying stock, and I'll describe this in a second. We have this relationship, which basically says, look, if we have T2 is a longer maturity, and so say T2 is 1 year, and then T1 is an option with say 6 months till expiration. So The 1 year option obviously has a longer expiration date. So what we're saying here is the value of the longer term option is greater than or equal to the value of the shorter lifed option. Okay, and so one way you can think about this is, and we'll talk a lot about this, is that options behave and can be used like insurance contracts. And so, they're option contracts and they're insurance contracts. And so there is an analogy there. And so one way to think about it is, if you have house insurance for 1 year, is that more expensive or less expensive than house insurance for 6 months? And you know right off the bat, the 1 year of insurance is going to be worth more. You're going to pay more for it. So you can think of an option from that perspective, a call option. The longer the maturity, the more valuable it is, all else being equal. And keep in mind, I'm using that all else being equal term carefully. Throughout this chapter, ceteris paribus is another way to phrase it, because we're attempting to change one thing at a time. It's very difficult to explain and analyze something when more than one thing is changing, because if more than one thing is changing, then you got to scratch your head and figure out, well, how much of the effect is from the first change, and how much is it related to the second change, and you get very confused. So in this logic that we're applying in this chapter, it's ceteris paribus. One thing changes at a time. And so here all we did was we changed time. Okay, let's look at the effective exercise price on a call. Now, the lower the exercise price, the more valuable a call option is. Because remember what an exercise price is when you hold a call. The exercise price is the price that you're going to pay for the stock if you exercise the option. So if that exercise price was lower, and by the way, you can't just lower an exercise price, but if you looked at all else being equal and you looked at various options and they had different exercise prices, everything else was the same underlying, the same time to expiration, everything was the same except the strike, then the option with the lower strike is more valuable. And the way to write that is, and this applies to either American and or European, is this. So X2 is greater than X1. The strike is higher. So if the strike is higher, then it's going to be worth less than the lower strike. The higher strike just means when you exercise, you're just going to pay more to get that stock. Okay. Now, let's go on to the lower bound of a European. Okay, we did the American a few minutes ago, and let's do the European lower bound. And this is going to take a little bit more, and there's some value in looking at this. And I'm going to fill out a table in a second. So recall we stated that the lower bound on an American call was simply, we said this. Okay. That was the American call lower bound. So the call price has to be greater than this intrinsic value. Okay. What we want to do is we want to get the lower bound on a European call, and it turns out to be mathematically looking like this. Okay. So here we have the European call, C with a little e. Okay. S subscript 0TX. Okay. That's going to be greater than or equal to the max. So everything looks the same so far, except we have this difference. We have this difference in that it's still the maximum of 0 if the option is out of the money, but if it's in the money, the European option is worth this amount. Now this difference here is actually larger than this difference. And what this x to the 1 over r, 1 plus r to the t power, that's simply the present value of the strike. And so if the strike was 100 and this was 100, then the present value of the strike, let's say an interest rate of 10%, and the option has 1 year life, then that just means this is $90.91. And so you can see that since this number is smaller, the gap here will be larger for a European. And why are we even making this distinction? Well, with the European option, recall, you can only exercise it at expiration. So you're not going to be able to pay X right now. You're going to delay the payment, defer the payment of if you wanted to exercise this option. So you need to take that time value of money into consideration. And we're using the risk-free rate R here, or the repo rate. Remember, we said basically they're interchangeable for our purposes. Okay. With an American option, you can exercise it immediately and pay the $100. Okay. So this, and by the way, you're going to see this throughout the chapter. In the next couple of in later chapters, you're going to see this discounting. And whenever you see something divided by 1 plus r to the t power, you're going to automatically recognize that almost always involves a European option, and that the American options tend not to have that discounting associated with it. So just be aware of that. It will help you clarify where you are in, we're looking at an American or European, so you can make that distinction. Okay, so now let's show how this boundary condition can be derived with no arbitrage conditions. So this is an important part of the chapter right here, because it sets you up to start thinking in terms of how to develop no arbitrage conditions in a very generic way. And I mean generic. I'm going to do this without any numbers. I'm going to fill out a table. So the purpose of doing this without any numbers is it's a proof in a sense that it doesn't rely on specific example. If I was to plug in specific numbers, that would suggest it's an example, and then you can easily disprove something with another example. But when you put things generically with literally just the symbols, then it applies to any situation, and then and so it's not specific example dependent. So that's the motivation for what we're going to do here. So let me clean up my notes here, and let's jump into the problem. We're going to look at a portfolio of two portfolios, portfolio A and portfolio B, and we're going to develop these portfolios and use them to try to determine a boundary condition. Ultimately, my goal is here again. Let's lose track. I want to derive this formula right here. Okay, so we have portfolio A. Portfolio A is a stock. Okay, we're long the stock. Remember, long the stock means we own it or we hold it, and we expect the value of the stock to go up. That's the way most people who are in the stock market, they own the stock, they're long the stock. Okay, then we're going to have a portfolio B, and we're going to compare portfolio A to portfolio B. Okay, portfolio B is a call option that we hold, okay, a European call, okay, plus a bond. Okay, now we want to compare and contrast the current value with the expiration value. Okay, and so that's what we're doing with this table that I'm about to build. So let me build this table out. And so I'm going to have here an area that says current value. And then we're going to have, and you're going to see this a lot later on, payoffs at expiration. Okay, payoffs at expiration. And we're going to define that a little more carefully. We're going to say the payoffs at expiration when the stock is below or equal to the strike. And we're going to differentiate that to when the stock is above the strike. Okay? So in this case, when you're looking at a call, when the stock price is below or equal to the strike, when it's below, it's out of the money. When the stock equals, when you invoke that little half an equal sign, means the option is at the money. Here we're looking at when the option is in the money for the call. So no matter what happens, we've covered every situation here. Notice that we've covered every situation. So now let's fill this out and we'll get a lot of intuition about what we're doing here. So the value of a long stock right now is just S subscript 0. That's what the stock is worth right now. Now, what happens when you get to expiration? What is the value of the stock? Well, the stock is independent of the call option in a sense. You don't have to have options on stocks. So you can have companies that don't have any options traded. The stock by itself is independent of the option. So no matter what happens, the stock at expiration is going to be S capital T. And so T stands for the time through expiration. Okay. So like we said earlier, we had, you can think of it, this is time 0. Right now, we almost always start off at time 0. And then we're looking at an option that has a life through T, period T. And remember, that's fractions of a year. So 6 months would be 1/2. T would be 1/2 for a 6-month option. Okay, so that's what we're looking at. So what is the value of the stock? Well, it's ST, whatever that number is. And it doesn't matter if the stock is above or below the strike. It's simply ST. Okay, so that's pretty neat. So the difference between this is your profit or loss on just owning the stock itself. Okay, now let's compare this this one stock portfolio to a portfolio where you own a call option, a European call, and a bond. Now this is where it gets a little abstract, but work with me here. The value of this generically is, for the call, is CE, European call, for a stock at price S subscript 0, for an expiration of T, and a strike of X. Okay, that's the value of the call symbolically, and then the value of this bond. Now we're going to put a bond. Now you would never think about. You would never think about this or think of to do this, but people have been working with option valuation going back at least to the 1960s. Seriously considered it. And so, lots of people spent lots of time putting this together. So it may seem like it's coming out of left field, but it's really not if you spend enough time in this world, no options world. So what we're going to do is we're going to look at a bond, right? We're going to look at a bond that pays off X no matter what. The bond itself, this bond, pays off X. And so the payoff of X is this. Okay, I'm going to fill in some numbers here in a second, right? But this bond is going to pay off X. So what I mean is we're going to buy this bond, and what's it worth today? What is the present value? So no matter what happens, you're going to get this X, this dollar amount of X, which is equal to the strike of the option, by the way. And so the present value of that is what it's worth today. Okay, so we're going to discount this strike back at the risk-free rate to the T power. It's risk-free in a sense that no matter what happens in the future, you're getting X. So that's risk-free. No matter what happens, you're getting X. So you discount it back at the risk-free rate. Okay, so what I've just done is I've just accounted for the bond component. This is the payoff at expiration. No matter what happens, you're going to get X. Now, what is the value of the European call option? Now, let's do this. What is the value of the European call option? Well, what is the value of this option when the stock is below the strike? Well, that option is out of the money. It has no value at expiration. So that is 0. So we just accounted for this. So what is this portfolio worth? Let's look at this again. The value of the portfolio right now is designated as CE, and then plus the value of the payoff of this bond. If you own this bond now, you're going to get X no matter what at expiration. So what's it worth today, the present value? What are you going to get now for this portfolio combined if the stock is below the strike? Well, the option's out of the money. It's worthless. You get X because it's a risk-free bond. Now, what happens, it's a little more complicated. What happens when you have this call and the call is in the money? Well, if the call is in the money, what you end up getting is whatever the stock price is, ST, minus X. That's what you get with the option. Okay, so the sum of this is the value of of this B portfolio at expiration. The stock is in the money. Okay, so now let's look at how this works now. Let's compare A and B. Okay, now, and we want to do this to see if one portfolio dominates the other. That's what we're doing here. Now, let's look at this column right here. Right here. Now, when the strike is greater than the stock price, which is better? Which is better, A or B? Well, it turns out that this is better, B, because X is greater than the stock price. This stock price will be less than X. So in the situation when the option is out of the money, you'd rather have portfolio B. It's more valuable. Now, what happens to the comparison between A and B when the option is in the money? Okay, when it's in the money, we're going to compare stock price at expiration versus this. Well, notice the X's cancel. Positive X and minus X, they cancel out. You're comparing ST to ST, no difference. So there's no difference. This doesn't matter. What matters is just this one scenario here where the stock price is lower than the strike. And so we see that portfolio B dominates. Portfolio B dominates. So how we can express that mathematically is that the value of the call, the European call, plus the present value of the bond. Okay, so this is the current value. The current value of this portfolio of these two securities must be greater than the stock price today. So I'm saying because B is a better portfolio in this situation, then that means that the value of B must be greater than the value of portfolio A. And there we have it. So we're getting really close to this formula that I showed you a few minutes ago. We're getting really close to that formula. All we have to do is rearrange it. X. Oops. And there we have it. There we have the lower bound for a European call. All right, here. In other words, this European call option must be greater than or equal to this intrinsic value, okay, which is a little just slightly different than the American intrinsic value that I had done earlier. Okay, and the difference has to do with that time value of money component. Okay, now we're in a situation, a better graph. I showed you a graph when we basically forced everything into, if you recall from algebra, the first quadrant. And so we are in the first quadrant of things here for valuing this option. So, or it's coming up with the boundary conditions. So we're going to put call here, okay? And we're in that, we don't care about the second quadrant, the third quadrant, or the fourth quadrant. We're only in this quadrant. And let's narrow it. I mean, this is a huge space. Let's narrow it down even more. Well, we've done that, and so let's do it graphically now. So we've actually done it. We said the upper bound on options is when the call equals the stock price. So remember, a call can only flip into the stock. That's the only thing that a call can do for you. So the upper bound, in other words, the most you can do going up this way, is the call equals the stock price. And we said that can happen when, if you recall in the notes, ST goes to infinity, or I'm sorry, just T, the expiration, the life of the option goes to infinity, or X equals 0. And how do I know that? Well, if S minus X over 1 plus R to the T is the payoff at expiration for an option, right? Well, what happens if X is 0? If X is 0, this payoff is what? The stock price. Okay, so then that means the call is equal to the stock. What happens if T goes to infinity? Well, when T, since it's on the bottom and it's the exponent, T goes to infinity, that means this whole bottom gets super large, which means this whole term drops to 0 and all you're left with is S. Okay, so that establishes this boundary. You can't be above this. Options can't be above this boundary condition where my fingers are. It's got to be somewhere down here. And let's narrow this even further. Okay. Well, we're going to narrow it down here. Let's narrow it first for the American option, and then we'll do the European and compare. Okay, for the American option, let's put a line here, a slope of one line, in other words, a 45 degree, and you'll see that again and again, and I'll elaborate on that later. And also right here in a minute. Let's establish that this is where the strike is. So you just draw, when you draw this, put the X and the Y axis, and just put an X somewhere in the middle for convenient purposes so you can see things better. And so this is going to be the lower bound on an American option. Okay, the lower bound is the maximum of 0 or S subscript 0 minus X. That's the intrinsic value. If you can exercise the option immediately if it's in the money. This is how much money you're going to get, S minus X. Okay? This is the lower bound. And so the option right here, you're right here, it has no value. When it's at or in the money, it has, well, act right here, it's out of the money, right here, right here, right here, it's out of the money, out of money, out of the money. Right here, it's in the money. You know, if you want to put a number here, say X is 100 and the stock price is 100, you're right at the money. 100 minus 100, 0. So the payoff is 0. Now, every dollar you go up in stock price, you gain $1 on the value of the option. So if it goes to 101 minus 100, you get $1 for that payoff on the call. So for every dollar you go up this way, you gain $1 this way. So this has a slope of 1. And you'll see that, like I said, you'll see that in a lot in later chapters with the slopes. Now, that's an American boundary condition. It turns out the European boundary condition is even higher because the European boundary condition, this guy right here, this lower bound is wider. It's higher. That lower bound looks like this for the European. Just abbreviate Euro, and that's the maximum of 0 or S subscript 0 minus the present value of the strike. Okay, so that's the European boundary condition, and this difference right here, the difference you see between the two, really has to do with two things. It has to do with R, the interest rate. Okay, so that accounts for its time value of money differences here. R and T. Okay, R and T account for that. Now, when the option is about to mature, at expiration, T goes to 0. This line right here that my pen is over collapses into this line. So when T goes to 0, the line collapses. If the interest rate, and you know, we were in a really low interest rate environment and kind of still are, you know, these two lines are not too far apart in today's world for option prices. And if interest rates are near 0, then the two lines almost overlap. Okay. So now what we have is we have the boundary space. The boundary space, I must have green. I got green. I don't know if it'll show up very good, but it's going to be this area. This area is the boundary space for an option. And it turns out, as we'll see later on, the actual option prices look like this when you graph them. Okay? So when a call option is deep out of the money, that means the intrinsic value is near zero. It's about zero. The option itself is worth almost nothing. So that well, I should say the intrinsic value is zero because there's no intrinsic value at this point. And then as you could go deep in the money on this side, deep in the money, you see that the value of the option is almost all intrinsic value. That'll come in, those observations will come into play in a few minutes when I decompose option prices into various components. So the point is, this is where option values lie. They tend to lie on this line, and when we do option valuation, we're going to look at this much more carefully. Now, one thing we haven't considered, and a little side note here, and I don't want to spend a lot of time on it, it's just kind of little somewhat trivial, is we need to consider the effects of dividends. And that's kind of not relevant to this graph anymore. So let me just get a new page here. You buy an option, time 0 is when you buy it. It matures at time t. We need to consider the fact that, you know, the stock that we buy during the life of the option, we buy the option here and the option expires. The option depends on the underlying stock. But what if the underlying stock pays a dividend? Does that influence option prices? And the answer is yes, it does. And here's how it works. When a company pays a dividend, goes ex-dividend and pays a dividend to its shareholders, the value of the stock, in theory, and actually drops by that value. You may not be able to observe it carefully on say the New York Stock Exchange because there's other things going on. So the ceteris paribus thing is a theoretical exercise, but you can't stop everything but one particular item in the real world. So in the real world, a company may pay a dividend, but you know that morning the Fed may announce, you know, it was doing something with interest rates. The stock market, you know, went down because of earnings, missed earnings forecasts and so on. All sorts of other things happen. But at least conceptually, and even in the real, I would even argue in the real world this happens, you just can't see it. You just can't yank apart all the different factors that drive a stock price in a given point in time. So I'm saying is, when a company pays a dividend, the value of the stock drops by the amount of the dividend. And usually at this point in time in class, somebody will stop me and say, wait a second, that can't be right. You know, when a company announces a dividend, the stock goes up. And it's like, yeah, well, that's an announcement of a dividend in the future. It's usually an announcement of a higher dividend. Yeah, a higher dividend will, when a company announces it, because what the company's saying is, look, we know we have this information that we have really strong cash flow for the stock, for the company, and we can pay a higher dividend. So companies don't increase dividends unless they know they can continue with that higher dividend. So it's a signal from management to shareholders that management's confident they have the cash to pay that higher dividend, and then that stock will pay a higher cash flow in the future. That's good, and that's why the stock goes up. But I'm talking about the payment of a dividend to shareholders. When that actual payment gets done, it reduces the value of the stock. And so at this point, you may not still be convinced, but let me give you another example. And often I like to go to the extreme of extremes to make a point, and it can help you in your reasoning at times. What happens if a company pays a liquidating dividend? In other words, it takes all its assets, turns it into cash, and pays it to shareholders. What's the value of the company? Well, if you looked at the balance sheet, right, you have a balance sheet with nothing on it because you liquidated the assets, turned it to cash, and then paid that cash out to shareholders. There's no equity and there's no liabilities. Everything's paid off. The company's worthless. Liquidating dividend liquidates the company, and the company basically no longer exists. And so the point is, when a company pays a dividend, goes ex-dividend, in this time frame, over the life of the option, it implies that the value of the option, the value of the stock will drop. And we need to consider that in the valuation of options. And so the way we do that, and the way the text does it, is it calculates S apostrophe subscript 0. And that equals the, so this is going to be S apostrophe subscript 0 will be the adjusted stock price for that dividend over this time period. That equals the actual stock price minus, so this is the actual stock price that you observed. This is going to be adjusted, backing out the present value of dividends over the life of the option. Now, this is not quite the formula. This is the formula, basically, that the textbook gives you. This is written differently. All I'm saying is you subtract out the present value of any dividends paid during the life. And it could be more than one dividend paid. If you have a one-year option, it could be 4 dividends paid throughout this. Your textbook has a formula for that that's very involved, but basically says the same thing. Just figure out the present value of those dividends and back them out. And the notation is kind of cumbersome, and I don't really care. All I care is you think about it in terms of the present value of the dividend is what we're backing out. Okay, now let's continue. And I want to differentiate, go a little bit further in this thing of a European versus an American call. Okay? And remember, a European can only be exercised at expiration, but an American can be exercised at any point. So therefore, an American option has more, sounds kind of funny, an American option has more optionality to it. It's more flexible than a European. So if you thought that, then what you'd realize is that, look, an American call can do everything that a European call can do and more. Okay? So that implies that the European should be less than or equal to the value of the American. And I'm writing that, I've got them switched around here compared to the notes, but it means the same thing. The American call has to be greater than or equal to the European call because the American can do everything the European can do, plus it has that extra optionality to it. Okay, so now why am I discussing this? Because what I'm saying is we had an illusionary lower bound here a few minutes ago. I said, look, here's the European bound and here's the American lower bound. And now what I'm saying is this guy right here, I'll mark it off. This was an illusionary lower bound because we just logically deduced that the American has to be greater than or equal to the European. So that means that this line doesn't exist. It should be cranked up till we get to this line right here. This line is the line. The reason we say that is we just narrowed the space even more. The space here was the space for all options, well, with an American, but really it closes it up a little bit more. Okay, so we tightened up those boundary conditions. So now we're getting at a point, continuing with the notes, is should an American option, now on a non-dividend paying stock, so we're looking at non-dividend right now, that's an important part of it. Should an American option ever be exercised early? Is there a time when you want to exercise that American option? Well, in a stock that pays no dividend, you do not want to exercise the option early. And boy, do some people have problems with that logic. Let me explain for the moment. I'll get to it deeper in a few minutes. People think they absolutely, they got an option, they got to exercise it, and they say, wait a second, why do you want to exercise it? It may not be optimal for you. Maybe you should sell it. And then they're like, what? Sell it? And then I remind them that, if you buy an option, you can sell the option. And it just never dawns on them to sell the option. They think that they bought the option and all they can do is exercise it. Well, look, if you bought something, you sold it. If you bought something now, somebody sold it to you. So somebody's on the sell side and somebody's on the buy side of these transactions. And people lose sight of that. And I'm telling you, don't lose sight of those two situations. It's the same thing I've told you with stocks. You buy a stock, you're bullish, but somebody sold you the stock and somebody sold you the stock. They had to be bearish on that stock or they wouldn't have sold it to you. So remember, there's two sides to the party, to a transaction. Okay? Now, what I want to do here is I want to decompose an option value into its various components and get some more intuition. So your textbook talks about call options, call value. And by the way, I use the word value and pricing pretty interchangeably. Value is technically related to a model. So we have a model for option pricing, and the model tells you the option should be worth $6.07. That's a value. Now, if you look at that same option that you valued and you look at what's the price on the Chicago Board of Options Exchange, that's exactly what I'm saying. What is the price? And the price could be $6.10. Well, $6.10 is the observed quote or the price. Your model comes up with 607. You could have a model that's slightly off or there's some other reason to account for the 3-cent difference. But remember, value and value is slightly different than price conceptually. If markets are working efficiently, and we have efficient markets, we're basically assuming that the value and the price are the same thing. And so that's why we often use the words, those two words interchangeably. So we're looking at a value of a call, and according to the text, there's two components. Okay, there's the intrinsic value which we've been working with. Let's see here, the intrinsic value. These intrinsic values, right, that we've been working with. And then whatever is left over is the speculative part of the value. So you can, if you believe value and price are the same thing, you can pull this number off the CBOE, Chicago Board of Options Exchange, for an option. You can figure out the intrinsic value because, look, you know what the stock price is, you know what the strike is, you would know what the risk-free rate is and T at any point in time. So you would back into this number. So you'd have one equation, one unknown. This would be the unknown that you would back into. Okay. I'm going to go a bit further, and this part is not in the text. I'm going to go a bit further and decompose this into three components. And I'm going to decompose it into an intrinsic value, like we see here. But I'm going to break out this speculative value. And I'm going to break it out into two pieces. I'm going to break it out into a pure time value of money idea, pure time value. And then I'm going to break it out into its speculative value or insurance value. Now, your textbook calls this speculative value. That makes sense. If you bought the option for pure speculative purposes, then you're going to get the intrinsic value, hopefully. The speculative value comes about because you're essentially gambling that the option is going to be in the money or even further in the money. You get that speculative value. But as we're going to find out in later chapters, that options are used, and I've told you this lots of times before, they're used for insurance purposes. In other words, to hedge your underlying position somewhere in your portfolio. So that means you have an insurance value. You can think of it as an insurance value if you're using the option for insurance purposes, or speculative value if you're speculating with the option. So two different motives for using an option. You can speculate it and try to almost gambling to make money, or you can use it to hedge and reduce risk. So that's what I'm going to break it out. I'll just define that a little bit better. But now notice I broke out this speculative value into two components. Okay. Now, let's mathematically put this together here and, operationalize it. So now I'm going to say, look, let's take the intrinsic value of an American, okay? And by the way, I'm not really, notice I didn't really talk about European or American. I'm kind of blending the two concepts together, but work with me here. And look, watch how I'm decomposing this conceptually to get a better idea what are the components that drive options. So here's the intrinsic value. And then what I'm going to do is I'm going to add an x minus x present value. So x minus the present value of x, and I'm calling that the pure time value. This was the intrinsic value. And then anything left over is the insurance / speculative value. So this pure time value of money only accounts for literally the time value of money, which is why I call it the pure time value of money breakout here. And notice, and this will be important later on, that the value of a call is made up of its intrinsic value, and it's made up of this pure time value of money component, and it's a positive right here. And why is it a positive? Because there is value to deferring exercise of the option. When you hold an option, if it's an American option, for example, you can hold that American option and defer exercising it. If you defer exercising an option, you're deferring the payment of the strike, X. Well, that has value because you'd rather pay the strike later than sooner or later than sooner. So the difference between these two would represent the time savings from deferring the exercise of the option. So again, if you want numbers here, let's think of if the strike was 100 and the interest rate was 10% and the option was 1 year, this whole component, this would be 100 minus 90.91. You'd have about a little over $9 in pure time value associated with the option because you can defer exercising the option a whole year. That's worth meaning it's a positive sign here, about $9.09. Okay. So what happens is we observe what the call value is. The call price we can observe on the CBOE. We can easily figure out the intrinsic value because we know what the underlying stock is in the strike. We can decompose these two because we know what the X's are, and we can look up on the nearly anywhere on the web at a financial website, and you'll get short-term rates for treasury bills. That, for example, a 3-month treasury bill, and you know what the time of expiration is. You get that when you get the quote, right? And the X is associated with the quote, and then whatever's left over is the insurance or speculative value. Okay. So now we can apply this. Let's take this example and use this formula, and let's actually pull it apart mathematically using the quote we did in chapter 2. So in chapter 2 we had a quote, okay, and if you remember we quoted S&P 500 contracts from the CBOE, and at the time the S&P 500 was 27, 29, 23. The strike on those options was 2,700. Go back in your notes to verify that. At the time, the options, it was November, and the options expired in June. So roughly 8 months. 8/12 is 0.667 of a year, 2/3 of a year to the expiration. If you were to go to, if you in November of 2018 November, when we looked at these prices, the interest rate was, the risk-free rate was about 2.4% for a 3-month treasury bill. Now we have all the information to fill in over here and back into what the insurance or speculative value is. So call price or value. Okay, we're going to use those interchangeably, equals the maximum of 0, S subscript 0 here, minus 2,700 plus 2,700 minus 2,700 and there we have it. We just broke out those components. Okay, so the intrinsic value here is worth 29.23. The difference between these two prices, because between S and X, because the option's in the money, so it's worth 29.23. Pure time value, this is worth $42.38. If you recall, this value from chapter 2 was worth $166. So you take $166, subtract the 29, subtract the 42, and back into what this number is, speculative insurance value, and that's $94.93. So that's how you back out the components. So you start to see, okay, option values, there's pieces to it, and here's what drives those pieces. And so moving right along, okay? So that was good. Now let's continue. We got more things to consider here, lots more. Let's look at the question of, I addressed a few minutes ago, should we exercise an American option on a non-dividend paying stock early? And I argued, no, we shouldn't be doing that. And that is the point. We should not be exercising early, but we're in a position to better understand why we don't want to exercise an American option early, okay, on a non-dividend paying stock for the moment. So now think about it this way. We can just refer to it here. When you exercise an option, right, an American option, what happens is you end up grabbing and you get the intrinsic value. So you're looking at an American option, which can be exercised early, and you exercise it, all you get is this component right here, assuming it's in the money. Obviously, it's got to be in the money. You'd be crazy to exercise an option early that's out of the money. You're literally throwing money away. But you're going to be throwing money away here also if you take an option that pays no dividend. What's going to happen is if you exercise that option, you're going to grab this component. You'll get possession of this value from the exercise because you're going to sell it at, or you're going to have something of value of S and you're giving up X. The negative sign means you're giving it up. There's an implicit positive sign, which means you're getting the stock. Nobody ever writes the positive sign, but it's there. And then what's happening is if you exercise the option, you're literally throwing away this. And you're throwing away this component. You're literally throwing those two values away just to get this guy. So my argument is if the stock doesn't pay a dividend, then why not sell the option? Sell it. Collect this value, and this value, which equals this whole sum right here. Sell it. And then if you're really dying to get your hands on the stock, use the cash proceeds from the sale of this option to buy the stock if you really wanted to do that. But the point is, when you exercise an option early, you're throwing away these two components. Okay? So now, how does that relate to a dividend-paying stock? Well, if you have keep this up here. If you're paying if you have a dividend-paying stock, and it's an American option, and you're debating, should I exercise it? Think about it. If you exercise the stock, say right before, or you exercise the dividend just before, exercise the option just before the stock pays a dividend, you get a hold of the stock and you're entitled to the dividend. And then the dividend's going to come to you. So when you exercise it, you're throwing these two components away and you're getting the dividend in place of these two components. So the question boils down to, should I exercise early for an American option that on a stock that has a dividend? Is the dividend greater than this value? If the dividend that you're going to get your hands on from exercising the option is greater than the sum of these two components, exercise the option, get the stock, because this will be worth more than the value that you're throwing away. You're throwing this value away, exercising the option, but if the dividend's bigger, it's optimal for you to exercise the option early. So so the reason for breaking this apart is to show you when is it more valuable to exercise an option, and what are the items that help you with that decision. And it's these two components relative to the dividend itself. Okay, now moving right along. Let's look at the effective interest rates on options. The interest rate on options, interest rates don't have, out of all the factors that influence option prices, interest rates tend to have the least effect on options. And you can see where it affects pure time value, for example. So when R changes, it's going to affect that pure time value component. But like I said, changing in interest rate's not going to have much of an effect on it. There's other variables that influence option prices much more. And so we'll talk a bit more about what that does. But notice what happens is if interest rates decline, right, for a call, if you're looking at a call and interest rates decline, this declines, right, this whole component right here goes up, right? And then the value of a call option is worth less, okay? The other way to say it is, and this is, I prefer to do it the other way around, is look, if interest rates go up, then this whole component here drops, okay? When interest rates are high, this value drops off, and it drives the call option up. Okay, the call option goes up in value because of the pure time value component goes up. Notice, I mean, you can't really see any insurance effect and any interest rate effects here. There might be some in there, but you can't really get your hands on it for the formula. You don't see any interest rate effects here. All else being equal. Now remember, you change interest rates, we're assuming the stock price remains unchanged, the ceteris paribus assumption. So this guy doesn't, this component doesn't change. This component doesn't change. It's really looking at this component, the pure time value, that we're dealing with. Okay? So when interest rates go up, this component right here drops in value, which means this entire component goes up in value, and the value of the call goes up. And the reason for that is, remember, when you buy a call option, let's back up a second. If you're bullish on a stock and you think the stock is going to go up, there's two things you can do. You can buy the stock outright, which is what most people do. They buy the stock, or you can buy a call option, because call options mean you're bullish on the stock. But, compare those two situations. If you buy the stock could be, the stock could be 27, 29, very expensive stock. The call option in this case was only $166. There's a huge difference in the cost to get into these positions per share. And so when you buy a stock and you have to shell out nearly $3,000, you're losing opportunity cost of money on that $3,000 versus only $166. The point is, when interest rates go up, buying the stock is not that attractive because you got to shell out nearly $2,700 to $3,000 to buy the stock. Okay? When interest rates are high, you're losing that opportunity money that cost. You're losing that because you could have earned money elsewhere with that based on interest rates. Okay? With the option now, you only pay $166. And so when interest rates go up, call options become more attractive in a higher rate environment. And so you have a value going up of the option. So you can explain it, intuitively get to it, to the understanding that in a higher interest rate environment, Call options are more valuable because you only have to shell out a little bit of money and you don't lose as much interest from that money that you just took out of your bank account or some mutual fund account where you could have earned a decent rate of return. Okay, let's continue. Let's look at the effects of stock volatility, another component. This is, out of all the factors that drive option prices, stock volatility is one of the most important. It has probably, other than the stock price itself, it's the underlying volatility of the stock that drives it the most. Okay, and you can think of it as the analogy that I've used in the past is, remember, you can use an option for speculative purposes or insurance purposes. And if you look at it from the insurance perspective, if you're an erratic car driver, car insurance is valuable to you, or you're reckless with your house, then house insurance is quite valuable. Meaning, if you have possible volatility in your wealth or your underlying asset, it's highly volatile, the option is worth a lot to you. Okay? If you're insuring something with it or you're using it for speculative purposes, if you're looking at it for speculative purposes and you see gyrations up and down, it means you can buy low and sell high. So there's more speculative value over the life of the option. So what I'm saying is volatility positively influences options. Positively influences the call option value. We can go one step further to get some more intuition, and this is kind of cool, but it's a thought experiment. Let's think of a riskless stock. No, there's no such thing as a riskless stock. But work with me here. If we had a riskless stock, right, what would that mean? That would mean that the stock, if I draw it like this, the stock price would move. So we had time here. You have the stock price. You would think that a riskless stock would just move like this. It's riskless. There's no uncertainty. There's no distribution here. It's all collapsed to the distribution. It's just a point. Okay. There's no risk. The stock never goes up. It never goes down. You know exactly where it's going. Now, that's almost a representation of a risk-free stock. But we forgot one thing. There's a slight bend in the curve because whenever you buy a risk-free asset, it's got to earn the risk-free rate of return. Think about this. It's going to be useful later on. If you own a risk-free asset, it's got to earn the risk-free rate of return. Otherwise, you'd never buy it. It wouldn't make sense because you're going to tie your money up and not get anything out of it. Why tie your money up for something that's going to cost $10 and no matter what, in 5, 10, 15 years or even 6 months, it stays at $10. You're not covering the opportunity cost of money. So in finance, when we have a riskless asset like a treasury bill or even put together a riskless portfolios, we assume that it grows at a slight rate at the risk-free rate. Okay, so it technically grows at the risk-free rate. Okay, but the point is, even if it's growing at this risk-free rate, and if this is expiration, this is time zero, and this is the expiration, we know exactly where the stock price will be. So if the stock is risk-free, that implies that the option, the call option, is risk-free also, because you know exactly what it can be converted into and how much you're going to get if you were to exercise it. So the option becomes risk-free. Now we can think about this a bit more conceptually. Let's look at it by summing together these two components. Let's get away from this perspective here and go back to for a moment the value of a call according to the text. Well, there's nothing wrong with it. It just combines a couple of features. Let's look at a European now, and we know that the intrinsic value is the difference between the stock and the present value of the strike. Okay, and then we know it has what we call insurance / speculative value. Okay, So we just combined, we back to exactly the way the textbook defined the two components. And there's nothing wrong with doing that, except that, I think there's more insight into what I was showing you earlier. But for this purposes, we're looking at a European option, and this is the way to decompose the price. Now, what happens is if sigma, the underlying risk of the stock, is zero, it means this insurance and speculative value, there's no component to that. The value of the option is simply this intrinsic value, okay? And so what happens is when you have nothing but intrinsic value, the value of the call, it's going to be in equals, it's going to equal this. And what I'm saying is you're on the lower bound when you have a riskless stock. So what I'm saying is you're on this boundary condition for European, X could be here, stock, the call. You're on this boundary condition, and that the reason for option prices being above the boundary condition is because of insurance or speculative value. And so if there's no underlying risk, this gap disappears, and the option folds into this, what we sometimes call hockey sticks. And so that the slang in option pricing is, you have calls and puts. You have call options with payoffs that look like this, which is looks like a hockey stick, and then you have puts that look like this. So that looks like a hockey stick, a payoff. And we're going to get the puts in a minute, and you'll see their payoffs look like that. So what happens is the option value starts to fold into that hockey stick. And so that gives you more insight that the reason for this insurance and speculative value is because of the underlying risk. It's also a function of the interest rate, because we also saw that differences can happen when there's differences in interest rates. So when you have some risk and you have interest rates, you're going to have this deviation that occurs over time. So also another deep aspect of this, which you may not think about, is that in order for interest rates to operate and in order for volatility to operate, you have to have time. If there's no time, then there's no chance for interest rates to have their effect, and there's no chance to have the stock going up or down, because the stock can only go up and down over time. So it gets at things a little deeper from that perspective. But when you get rid of uncertainty, you get rid of, you now are on the boundary. And you move from this curve line down onto the actual lower bound. And that's the point. Okay, now let's switch gears a little bit. Let's get the put options. And let's look at the boundary conditions and puts. And where we're going with this, we're going to draw you, when I get done this section, I'll draw you the boundary space for a put. And in the process of developing that boundary space and confining that space, you'll learn a lot about what drives puts. Okay, so the first thing we want to do is look at the minimum value. The minimum value of a put. Now remember, what can a put do for you? Well, the only thing that a put can do for you is, you can sell the stock at strike X. Okay, that's what a put can do for you. But if the option is out of the money, you're not going to do anything with it. You're not going to exercise it. So from that perspective, that optionality idea means that since you're not forced to do anything, if the option is out of the money because the stock is above the strike, then you're not going to exercise it. The payoff is zero. So the put has to have a value, and we'll denote that value similar to calls. It has to be greater than or equal to zero. Okay, if it's in the money, it's greater than. If it's out of the money or at the money, you invoke that little half and equal sign. Okay, so that's the minimum or lower bound on the put. Okay. Now with an American put, and by the way, notice no little e, no little a right here, because it didn't matter. This is the lower bound for an American or European. Now an American put can be exercised early if it's in the money. And so its boundary condition is a little bigger. And so the boundary condition for an American put is going to be greater than or equal to the maximum of 0, or x minus s subscript 0. Okay, that's the intrinsic value of a put. If the put's at or out of the money, the payoff is 0. And if it's in the money, it's x minus s. Notice the terms are reversed, because you're implicitly going to get the value of x, because you're going to sell this. Your put gives you the right to sell at x. So you sell the value of the stock at x, you implicitly get a positive dollar amount of x. Nobody ever puts a positive sign in front of it, but there is one there implicitly. And you're giving up the stock, which is why the minus sign is there. Okay? This condition does not hold, by the way, for Europeans. So you can't use this for Europeans, because it may be optimal to exercise a European option early, a European put, an American put early. It may be optimal to exercise an American put early. And I'll get to that in a little bit when we decompose option values and so we're not quite ready to get there yet. Let's look at the other boundary conditions before. Let's look at the maximum boundary, the upper bound, the maximum value of a put. Okay, the maximum value of a put. Remember, I said a few minutes ago, the most you can do with a put, and we're looking at an American here, is we can convert the put into X. That's all you can do with an option. You have an American put, and all you can do is flip it, and you can sell the stock and get X. So that's the most that the option can be worth. So this is the upper bound, meaning that X is the highest it could be, and the put's likely to be below that upper bound. Okay, so notice the funny thing is, but look at this upper bound. This upper bound's a constant. X doesn't change. Okay? Now for a European, with the European, you have to delay getting your hands on the strike, because you have to delay exercise, which means that the upper bound is a bit lower. It's going to be X discounted back at the risk-free rate. And so this is the present value of X. So this bound is a little bit lower for the European, which is, again, signaling that a European put is worth a little less than the American put. So it may be optimal to exercise an American put early because of that. Because remember, it has to do with time value. You exercise it, you get your hands on the cash flow early with an American, and you can invest that cash flow and get a rate of interest of R. And so that makes the European options more valuable from that perspective. Now let's do a couple of examples, brief examples. Suppose you have an American put and a European put, each with a strike of 50. So we're doing an example that's in the notes. The interest rate is 4%. The company just went bankrupt, so S equals 0. Okay, and the maturity of the option is 6 months. T equals 1/2, and that's 0.5. As some background. Compute the upper bounds on each put. Okay, now for the American, the upper bound is simply going to be $50. That's the upper bound. Okay, so we're imposing the maximum value is going to be this equal sign. Okay, now for the European, the upper bound is going to equal 50, but you got to discount that at 4% for half a year. And that means the upper bound is $49.03. These are fixed amounts, as you'll see graphically in a few minutes. Okay, now the effective expiration. The longer the put life, the more valuable it is. Okay, so the longer the time the expiration, the greater value of the put. It's kind of like a call that we're dealing with, and I'm going to give a summary of that later on in the notes. It holds almost perfectly, by the way. It's not 100% perfect, but time to expiration, usually with the longer the time to expiration, the more valuable the put. It holds most of the time, but not 100%. And I'll talk about that at the end of the notes when I summarize when I summarize the factors that drive option prices. So now we are in a position to look at, let's just look at the American boundary conditions for American puts. So we got puts. We're looking at American. Let's do that first, and then we'll do a little bit of decomposition, and we'll look at European options in a second. So now, remember the maximum value of a put. Remember I told you it was a constant for an American, because that's all you can get is X. So this is the upper bound. It's the most you can get of that option. So already, by the way, I basically got rid of this quadrant, and this quadrant, and we're only in the positive quadrant here, quadrant 1. And I've already chopped off everything above here. Okay. So now let's see if we can confine the boundaries. Where should a put option value be? Where does it make sense? Well, I also told you that the minimum value, the lower value, is the maximum of the x minus s. So we draw this line, and here, you think I'll draw it thick. Draw it thick. Here, that line is denoted as the maximum. It's the intrinsic value, 0 or x minus s 0. So if you have an American option, this is what it's worth, the lower bound of it. So when the option's out of the money, right, it's worth 0, out of the money here. When it's it's at the money, it's still worth 0 at the money. Now for every dollar the stock drops, the payoff goes up, because this will stay fixed. This number drops with a negative sign, means this goes up. So this has a slope of -1, as we'll see later, and I'll use later on in a later chapter. So it has a slope of 1. Stock goes down, the value of the option goes up. And as I said, kind of like with call options, I mean, this is the space. The option will be in this space. It won't be here. So cross this out. It won't be up here. Can't be here. Can't be here. It's going to be in this space here. And typically the way these options work is the actual graph of an option will look something like that. Okay. And by the way, you'll see this if you look at the thumbnail closely for this course. So what I mean by thumbnail, if you go to YouTube and you look at the courses, you got these purple front of the cover of the video that I have. You can see these graphs and these payoffs and these option values, and you see that here you have an option value. And why is that different than, why is it off the minimum bound? Because the underlying stock has risk, there's interest involved, there's interest rates, and there's also time to expiration. And so as time goes on and the option's about to expire, then there's very little interest effect. The volatility effect starts to dampen down, and then you get an option that this line here starts to fold into this thick black line, to the point where after a while you're going to get something that looks like this, and it's going to start to develop kinks until this line folds right into the black line, sinks and melts into the black line, the heavy black line. Okay. So that's an American, that's the boundary space for an American option. Now let's do a slight digression and go into the components of option, put options. So the way your text talks about it is, look, you can have a put option, and so the put value is equal to its intrinsic value plus it'll say it's speculative component, okay, which I would also argue that is an insurance component if you're using the put as insurance. And you will see puts are a really valuable insurance product because we have what's called, we'll literally put together a protective put later on in the course. And a protective put is known as portfolio insurance. So if you have a portfolio of stocks that are fairly well diversified, you can buy S&P 500 put options and insure your portfolio against losses and to mitigate those losses. And that's coming up later on. Again, part of financial engineering. You don't like the situation you're in and that the market offers, rearrange it till you get the risk and return profile that you want. Okay. So now let's continue with the put here. So a put has an intrinsic and a speculative value, but I'm going to decompose that by breaking this guy out here, in a sense. So I'll go look at a put value, and I'm going to say it's the maximum of 0 or x minus S0, okay? I'm not really distinguishing between American and European here. I'm not making a distinction. And we have pure time value. Now notice, before I go any further, I put a negative sign in here because this pure time value component hurts puts. Okay, it hurts puts by this amount, the same amount that we saw with call options, the pure time value. It's negative because if you hold a put, you're deferring the exercise of that option, which means you're deferring getting X. Well, X can be valuable in a high interest rate environment because you can take X and invest it in a bond or something in a risk-free rate that earns a lot of money for you. And so that's what this component is telling you. There is a pure time value component. There's an intrinsic value, and then you have the insurance and speculative value. Okay, so the point is, when you hold a put option, you are delaying the receipt of X. You're not getting your hands on X early. Well, there's a cost to that. It has a negative impact on the value of the option. Okay. Now, let's do a boundary condition. Let's look at, I showed you the American boundary condition. Let me show you the European and kind of combine the two. Okay, so let's put the graph here. And we got the put. And remember, with the American, it was X was the upper bound. It was a fixed upper bound. That was the max. And we had the lower bound being this on the American. Okay, but now we have to account for time value of money differences with the put. So the put has a negative component, right? To because of interest rates. And so now what that means is this is X over 1 plus R to the T power. It's lower, but it's constant. Okay, so this is the American, this is the European upper bound. So the European is a little lower from that perspective. But then we also have to consider that we have to discount this whole payoff. It's X over 1 plus R to the T also. So the European, I don't know if you can see that, but this line is green. This line is green. And so the boundary space is a little different, same shape basically, but the whole thing is shifted down for a European compared to the American because you delay getting your cash with the European. So the boundaries, the actual option, so by the way, the formula for this guy right here this is the maximum of 0, comma, x1 plus rt minus s subscript 0. And this was the maximum of 0 or x minus s 0. Okay. So the boundary space is what's in this middle right here for these options. Now let's talk about dividends and put prices briefly, and then the question of should we exercise American options early. So with dividends, when a stock pays a dividend, right, the stock price goes down, and that could be, and that's good when you own a put. So when all else being equal, if a company increases its dividends, it's going to cause the stock to drop. When it pays that dividend, it causes the stock to drop, and you're happy owning a put because that put is going to go up in value. Okay, so now the next question is it ever optimal to exercise a put early? Or are we simply better off selling the put to get out of the position? So that's the question. If you want to get out of the position, do you exercise or do you sell? Okay, with puts, the pure time value of money drags down the holder. It's negative, meaning it may be better to exercise the option early when the pure time value component is greater than the insurance value. The pure time value component and absolute value is greater. So, let's see. What the heck did I do with it? Yeah, I'll let's write it out. The put value, recall, we said was the maximum, was the intrinsic value plus the minus x minus the present value of x t plus insurance speculative value. Okay. So now we're talking about, should we exercise an American early? When you exercise the American early, you're throwing this away. And you're throwing these components away, and you're getting your hands on the intrinsic value, which is x minus s0. You know, assuming it's in the money. You'd never exercise it if it's out of the money, so it's got to be this guy. Can't be the 0. Can't be this. You exercise it, you get this, you're throwing these two components away. When I say throw away, well, you're literally throwing away the insurance or speculative value, but throwing away a negative is actually a positive. So when you throw away this and get rid of this, it's actually good. So the point is, you exercise an American put early if you think that if you think this component in absolute value is bigger than the insurance value. If this insurance value is small, meaning you're throwing away a positive thing, it's very small, close to 0, you're better off exercising it from the pure time value of money perspective. Okay? So that's how you decide whether or not to exercise an American put early or not. You need to compare these two. Now, under most circumstances, this insurance and speculative value will be larger than the pure time value. Especially if the option is volatile, then it's likely that that insurance value is higher. Now, you got to look at, again, the T, what's the expiration, what is the interest rate? And, if you're very close to expiration, this guy is very, very small. This is probably going to be larger. But, there's a lot of moving parts here. All I'm saying is most likely the insurance and speculative value will be larger than the pure time value, which means you might want to consider exercising that American option early rather than delaying. Okay.